On this episode of Max Spends All Day Researching Due Diligence for Your Entertainment and for the benefit of your bank account, title pending, we are covering the highly requested Corsair Gaming. Now, Corsair Gaming, if you aren't familiar with them already, is a gaming and streaming hardware company that create just about everything from PCs to keyboards, headsets, microphones. They have the Elgato brand, which is a huge brand. They do all things for hardcore gamers and streamers. They're the high-end product, and they have captured a ton of market share in this market and have had the best year in their 27-year existence because of a little thing, you may have heard of it, called COVID-19 and the lockdowns. Gaming and streaming has been better than ever. So in this video, we're going to do an overview of Corsair Gaming. You're going to feel like a Corsair insider after about 7 minutes of this video. You're going to know everything you need to know about the company. Then we're going to go into their financials and a stock screener to look at some ratios, comparing them to their closest competitors to see whether this company makes financial sense on top of riding this massive wave of streaming and gaming that they are kind of on the top of right now. And then we're going to do a price target to see whether this is worthy of us dropping our hard-earned dollars into the stock and letting it sit and reaping the rewards. Then we're just going to do a quick rating on our new scale here on the channel. We're going to give it a rating somewhere between the scale of Dookie Shoes and Golden Shower, and you can probably guess which is the better of the two. So let's just go ahead and jump in here. We're going to start with their Q4 quarterly results because, like I said, they had the best year in their 27-year existence. So let's go ahead and start off with this. We can see some highlights from their Q4 here. Net revenue increase of 70.4% year over year to $556 million. A gross profit was $153 million, an increase of 118% year over year. Operating income was $58.9 million, an increase of 314% year over year. Their adjusted operating income was $71 million, increase of 166%, and their net income was $43 million, a huge increase as well. So they have had a massive year. They're not going to have a year like this. So we have to take that in consideration, where they're going to be in the next 5 or so years, which we'll do that in a little bit. But first, let's look at their investor presentation. This 39-page beast, but don't worry about reading through all this. There's about 4 pages that I really want to highlight here so you can get an understanding of how they think and the company in general. First off, they do a pretty good job of putting this together. It looks pretty neat. So we're going to go to page 7 first. And this is a really good point that they made, that gaming has only gotten bigger over time, and it's probably going to just get bigger and bigger as games and especially like VR and things like that just get more and more realistic. But they're saying that the total potential industry size is 2.6 billion gamers, which is just mind-boggling huge. And this is something that I really look for in companies that I invest in, is a company that can touch as many people as possible, not touching the bad way, get your head out of the gutter. But 2.6 billion people is a lot of people. It's a lot of people. That's like as many people who are going to watch this video. Yeah, I wish. Page 9, there's also something that I wanted to highlight here. So they focus on streamers and high performance gear and gamers who are very serious about their gaming. So they say that for mobile gamers, yeah, there's 2.4 billion mobile gamers, but there's not really much they can do for them. For console gamers, they have a controller, headset, they could sell them a headset. For PC gamers, there is a ton that they can sell them, and that's really what they focus on. And for streamers, there's even more. Like, I basically have like what would be a gaming streaming setup right here. It doesn't look like much because it just looks like I'm floating around in space to you, but I have about $6,000 worth of various gear to make all of this happen, and it's not cheap. And there's a lot of people who are trying to do the same thing, and they're willing to spend the money. That's what they talk about right here. Many gamers and streamers are willing to spend the money for the dream of becoming the next big gamer or streamer. Something that I think about all the time is I bought a custom PC last summer just for video editing, and the person I bought it from had said that he has seen more sales than ever because this was right after that first stimulus check, the $1,200 stimulus check came out. So many people got their check and they're like, first thing I want to spend this $1,200 on, a new PC for gaming. And this is exactly what Corsair does. Now, if we go to page 14, we can see kind of their focus here. Their focus is competitive, committed gamers. And they say, well, that only makes up 18% of the total PC gamer population. That makes up 83% of the PC gaming spend. So they're focusing on the high spend, high quality, the people who are trying to turn this into a business and are really willing to spend the money on this stuff. But a business is only as good as the industry it's in. If you can be an amazing business, but if the industry is trending downwards, there's only so much you can do. You're probably not going to succeed a whole lot. Alternatively, if you're a poor business in a good industry, you're probably going to see an upswing. But if you're a great business in a great industry, that's when things really take off. So I did find an industry analysis here that shows that the gaming industry is expected to grow at a compound annual rate of 10.4% over the next 5 years. Now, that was actually a little bit lower than what I expected, but then if you think about this is a multi-billion-dollar industry already, and to grow 10% a year, that's kind of insane. Also, one thing that I was really curious about here is how good are their products? I don't personally own any of their products. I'm actually surprised I don't have any Elgato products because I use streaming stuff, but I don't have any of their products. So if you just look at a basic search on Amazon, you know, they have mice, they have, is mice the plural for one of these kinds of mices? But I don't know. They have headsets, keyboards, you know, all things gaming. But if you take a look at their reviews are actually kind of amazing. And like this one, 4.7 out of 5, 2,500 reviews. And that's pretty much the case for like all of their products, just amazing reviews. So that says a lot about their products and the happiness of their consumers. Also, one thing that you need to know, you absolutely need to know, you can get 2 free stocks with Webull. All you have to do is make a $100 deposit. And the best thing is you'll be helping out this channel because they will send me a free stock as well. So it's kind of a thank you for this due diligence and me spending the last like 5 hours working on this Corsair video and not home with my cats and my girlfriend. But anyways, if you want to do that, links down in the description. From here, the next thing I wanted to talk about was what the employees think about the company. And this is one potential concern of mine, because if we go to Glassdoor, we can see that their employees, or ex-employees probably, rate them 2.9 out of 5, which is not amazing. Now, I don't want to put too much weight on this because I think most of the people who are going to rate the company were probably fired for the company. And we don't know if these are just like the loser employees who are fired and then, you know, rating. But you do want a company that has great ratings. If you think about companies where the employees just love the company, some examples that come to mind are like Starbucks or like Southwest Airlines, where the employees are like actively just constantly promoting how much they love that company. That does make a big difference just in the long-term outlook of the company. So that's one potential concern of mine, because we're not here just to hype up the stock. We're here to have a realistic picture of everything that's going on. And with that being said, let's go hop over to their financials. For a brief overview, we can see that they have a market cap of $3.15 billion. They're pretty big. Revenue per employee per year, $706,000, which is pretty darn high for a hardware company. Earnings per share of $1.13. And a P/E ratio of 30, which is a little bit on the high end for a hardware company. But if we're comparing this to just esports in general, it's very low. One way I kind of have looked at Corsair through this analysis is it's kind of an esports play without having to deal with the crazy esports multiples. Like if you're trying to buy into an actual just esports company, a P/E of 30, that's unheard of. It's going to be more like a price to sales of 50 or 80 and probably like an infinite P/E because they probably don't have any earnings. So if you compare it to that, it's pretty good. If you compare it to traditional hardware, it's on the high end. So it's just something to consider. If we look over at their financials, we can see this nice stairway to heaven, stair-step trend in the last 5 years. That is exactly what we're looking for. And on a quarterly basis, we can see the exact same thing, just chef's kiss, looks great on both of those. One potential concern is the earnings per share. It does not look like that. We want that nice stairway to heaven on the earnings per share as well, but we have a little bit of earnings and then negative earnings and then a big jump up in 2020 when they saw a huge increase in sales. So it's better than just negative, but it's not nice and consistent. Like you want your investments to be consistently cash flowing more and more and more. But digging into this a little bit more, it's because they took on a lot of additional debt in 2018 and 2019. If we go over to their balance sheet and look at their total liabilities, we can see that their liabilities have increased dramatically in those years, and their goodwill probably increased as well. If we look at their goodwill on the balance sheet as well, we can see a big addition here and then a big addition in 2020. And that likely means that they made some significant acquisitions in those years and took on additional debt because of that. And the acquisitions can be a great thing as long as the management is doing a good job of it. Now, further diving into the financials here, we have the stock screener. Now, this stock screener is kind of built to analyze value investments. So we have to keep that in consideration when we're looking at Corsair here, because Corsair is more like a growth investment. It's kind of like a borderline because they have earnings. It's still good to look at these ratios and see where they stand. So P to E, I really look for a growth investment between 6 and 15. And we're at 30. So we're on the high end of that for a growth investment. But with this, we're just trying to check as many boxes as possible. We're not trying to check every single box, or it's unrealistic to check every single box. For the price to book, we want between 0.6 and 1.5. We're at 3.7, which isn't that close, but again, same deal. We want to check as many boxes as possible. Debt to equity ratio, this tells us how leveraged the company is. You want this around 1. They're at 2. It's okay. Current ratio, you want this over 1.5. They're at 1.38. That's pretty good. Market cap, I really just look for a company that's $100 million in sales or more. And I look for a dividend yield between 2 and 7%. In value investments, again, this is kind of a growth play. They don't have dividends yet. They probably will within the next 5 years. Then we want to determine whether this company has a competitive advantage. A company with a competitive advantage is just going to be more profitable and see more sales and is less likely to fail in the long term. Basically, does this company have a big moat dug around it? And the answer for Corsair is kind of. They're pretty good. The gross margin here is 25.61%, and you want that as high as possible, of course. Coca-Cola is 60%, just for comparison here, but of course they're not in the same industry. 25% is pretty good. SGA to profit, you really just want this as consistent as possible year to year. Their ratio is pretty high. They are consistent with the exception of the years where they made acquisitions, where there's a jump up, which is totally understandable as well. R&D to profit is 10%, a little bit on the high end, but again, they're making products, so that's completely understandable as well. Depreciation to profit, very good, 2%. And for example, here to compare that to Coca-Cola, Coca-Cola is 7%. So that's pretty darn good for their depreciation. Receivables to sales, we want to compare this to some competitors. So their ratio here is 17.27%. And we can see if a company consistently shows a lower percent of net receivables to gross sales than its competitors, it usually has a competitive advantage. Now, Logitech has a lower gross receivable ratio here, which they're better off, but Razer is higher. Those are two of their top competitors. So they land right in the middle of those two. Their return on assets ratio, which shows the percentage of how profitable a company's assets are at generating revenue, is 7.88%. Again, Logitech is better in this case. Razer Incorporated is much worse. You want a company that makes the most amount of money off the fewest assets. A company that makes $100,000 in profit on $1 million in assets is worth way more than a company that makes $100,000 in profit on $10 million in assets, because you got to double that 10 million in most cases to make another 100 grand. Return on equity. You want this between 15 and 20%. It's the management's ability to generate income based on the equity available. They're at 23%, which is pretty darn good. Logitech, even better, 38%. Razer Incorporated, not so great at less than 1%. So they land right in the middle of those two competitors. Interest expense, which is just how much interest are they paying on their debt, it's 3.99%, which is pretty darn good. I wouldn't mind some loans at 3.99%. Their net earnings are 6.05%, which isn't great, but I expect that to go up in the next few years as they really reap the rewards of their increased sales. And their earnings per share, you want this stable and increasing. It's not really stable because they took out all that debt in 2018 and 2019. Their cash on hand, they don't have a ton of cash, 133 million compared to their revenue. Not amazing, it's okay. Inventory, you want your inventory to increase at the same rate as your net earnings. You want them both to be stable and increasing. Their inventory is increasing. Their earnings, again, are all over the place. If both of those are increasing, it basically just says the management is finding better and better ways to sell more stuff at more profit. Goodwill is generally a good thing. if the management does it well. We saw a jump in goodwill in 2017, 2020. Again, that's because of acquisitions. Additional stock, you really want to avoid a company that has preferred stock in most cases, and you like seeing treasury stock. Now, Corsair does have some preferred stock, but its treasury stock outweighs it in the same year. So I'm just going to, cross that, render that null and void. Investments in debt, you really want a company that can pay for all their debt with their net income in 4 to 5 years. In Corsair's case, it's 8.5. But again, this is kind of a growth play. So a lot of these, there's a little bit more tolerance if you expect the industry to do really well, if you expect the company to do really well in the future. So without further ado, let's go ahead and do a price target analysis here. So in the last 5 years, their earnings per share growth was 250%. Massive, almost 100% due to the last year just skyrocketing in growth. That annualized is 28.47%, which is pretty bonkers. I don't expect that to continue at that rate, so I'm going to do an analysis based on an 8% growth over the next 5 years. Given that, it would come out to $1.67 in earnings per share in 2025, which would be $151 million in earnings in 2025. That's a conservative estimate. I'm going to also do an estimate based on a more bullish scenario in just a second here. So based on a P/E of 30, that would give us a market cap in 5 years of $4.53 billion, which gives us a price target of $49.29 within 5 years, which is a 41.31% return and 7.16% annualized return. 7.16%, it's okay. It's not the greatest ever, but it's okay, especially for a strong, established industry player in a growing industry. It's pretty good. It's no 100% meme stock return, but it's pretty good for an established business. Now, if you were to say, okay, that's not realistic. They're going to grow way more than that. The industry is going to grow way more than that. I did another analysis just for you. We're going to do a more aggressive 12% earnings per share growth. That would come out to a market cap of $5.4 billion, which gives us a price target of $59.10 and a return after 5 years of 69.44%. Nice. Annualized at 11.12%, which is pretty darn good. It's not the most spanking deal of all time, but as far as an esports play, that's also kind of a value play and a growing industry, there's a lot to consider here. And in no way would it be a bad investment. Of course, you always want to do your own diligence as well. I'm not your mom. I'm not your priest. I'm not your messiah. Do your own diligence as well. This is not financial advice in any way, but there is reason to consider this as an investment in your portfolio. So what are we going to rate this thing between Dookie shoes and golden showers? Well, we're going to give it a bingo bango, which is again pretty good. So that's going to do it for today. Make sure you like this video, subscribe, do all the things if you appreciate my efforts here. And I would just like to thank you so much for watching, and I hope you have a profitable day.